All right, good morning, and welcome back to the latest edition of the InvestTalk market analysis for the week ending October 13th, 2023. And I am re-recording this on Monday. I had some audio issues, and YouTube's had some audio issues lately. So I'm just trying to do another video. We're going to get some updates this Monday morning on prices. But ultimately, this is really about what happened last week, and we'll obviously touch a bit on this morning's action as well. Now, I'm Justin Klein, host of InvestTalk. I appreciate you all tuning into this channel, liking and subscribing to our podcast, InvestTalk. Now, this week, we're going to title the video, Geopolitical Tensions Spark a Gold and Oil Breakout. And we know what's happening in the Middle East. This is probably the start of continuing rolling crises throughout the Middle East and Europe as we pull back, the U.S. pulls back from being the global hegemon to a degree, and refocusing on domestic politics, which obviously are continuing to become more divided. And so the problems we're seeing in the Middle East are probably not going to change anytime soon, which gives some general tenor and underpinnings to what's happening in the market right now. But let's talk about the economic data that happened last week. Of course, PPI came in basically flat, little tick up there. Same with the PPI, little tick up there as well. So core PPI and the PPI did move up a little bit. And this is producer price indexes. Remember, this tends to lead the consumer prices. Okay. And consumer prices, they did tick up just a slight bit on overall, so 3.67 to 3.7, and then core did tick down a little bit to 4.13, the lowest level since, let's see, go all the way back to September of 2021. So that's where we're at. The export prices, import prices, those did tick up a little bit, but still in negative territory. And that all fed into a Fed policy that looks to pause this month. This was basically, call it a flat reading, not an acceleration or deceleration in these numbers. And a lot of it has to do with base effects. If you look here, the numbers started to come down in late summer into the fall. And so the base effects are more difficult to really see an acceleration to the downside in inflation as those base effects get a bit easier. Now, the Fed this Monday morning pricing in 90% chance of a rate pause, and that's only in roughly 2 weeks. 2 weeks. November 1st is coming up. Let's see. November 1st would be, that next 2 weeks from Wednesday. So you are anything over 80 is basically the market pricing in a guarantee, and the Fed doesn't like to surprise the market. So they did come out with some rhetoric throughout last week that talked a lot about the long end of the curve rising and thus creating a tighter monetary policy or tighter policy for the economy as a whole. And so maybe they have to do less. Right. And so in some ways, the Treasury's issuance of so much debt, $1 trillion in not just short-term bills, but bonds and notes are what is driving up the long end of the yield curve and creating tighter policy. So what you can see here is there's a kind of a hand in glove situation going on with the Fed and the Treasury, because the Treasury needs to issue a lot of securities with our debt situation and our deficit situation accelerating to the in worse negative territory. And the Fed is trying to tighten policies. So and the prevailing interest rates. Remember, the Fed only influences short rates. It does not influence long rates. But the Treasury, based on how they want to issue the debt between short and long term, that can have an impact on the yield curve. Or does have an impact on the yield curve. And so what they had been doing for most of the early part of the year was issuing more bills. And typically they want about 20% of the debt outstanding to be in bills, meaning short term, a year or less. And now they're at 22%. So pretty much all of their debt they're going to be issuing going forward is on the longer end of the curve. Now it could be only 3 years or 5 years, something like that, but certainly some of that is going to be in the long end as well. So that's been driving up interest rates. And this is a trend that will likely continue to be something the Fed is going to have to support that at some point. where if rates get too high and fiscal policy gets, or sorry, monetary policy gets too tight, and the Treasury issues too many bills, rates on the long end go up too far, the Fed was likely going to have to step in and do something about that. And maybe it's the Fed saying, hey, Treasury, why don't you issue more bills and not create more problems on the back end? And the reason why that creates problems is because when you buy long dated securities, a 10-year bond, for example, there's a risk there. There's duration risk. There's obviously not credit risk with treasuries, but there's duration risk with 10-year treasuries, or anything longer than 1 year. When the Treasury issues bills, it doesn't really create a situation where there's balance sheet risk, because there's pretty much no risk there. Rates go up near term, they're going to mature soon. Okay, so that's what's happening in the Treasury market, and I'll pivot over real quick to that chart here, and the 10-year continues to kind of march higher. It's kind of paused last week, pulled back a little bit, but this is still in a clear uptrend. And the yield curve continues to uninvert. And so this is really important to watch and see how much further the Fed lets the long end of the yield curve go up. And ultimately, they're probably going to have to pause QT. Okay. But once again, it's a relationship between the Fed and the Treasury. The dollar is obviously important as well. That has paused its uptrend. This is looking definitely weaker than those 10-year rates, down again to this morning. And so that is positive for risk assets. We're getting to a place, going back to last fall, I'll zoom out here, when the strong dollar was creating major problems, and the Treasury, the Fed, together kind of helped weaken the dollar, but that has reversed in a big way, and you're starting to see things break as well. Last fall, you had the gilt market break, you had the Bank of Japan JGB market break, and that became an issue geopolitically. And so we know global central banks they coordinate with each other, and clearly they were seeing problems then, and they're likely seeing problems once again. All right, let's dig into a few other major topics. The commodity space that had a resurgence last week after the pullback, and this remains in an uptrend despite that dollar move. That's what's so interesting. Going back to the dollar real quick, look at this. Since basically mid-July, the dollar has been on a tear. But if you look at the commodity space, this is the Bloomberg Commodity Index. Let's go back to mid-July. The commodities are up. That should be the opposite, right? Strong dollar should should weigh down on commodity prices. So what happens if the dollar weakens? I think commodities really take off, and you see that in gold as well. This one had a strong end of the week. You're getting a pause here on Monday, but this was a big reversal. We broke down after the last Fed meeting on the strong dollar and hawkish rhetoric, blah blah blah, but that has been all reversed due to geopolitical tensions, as well as that Fed rhetoric that, hey, higher long-term rates are going to weigh on financial conditions, and thus we'll probably have to raise rates less. That's basically the gist of what many of the Fed speakers last week were saying. And so gold has paused. Even GDX is up today, despite gold being flat. And always watch for this gold GDX to gold ratio that continues to move higher. So we'll be continuing to watch that, but it does look like it is breaking out. Obviously, oil breaking out as well at the end of last week, and then you had UNG. This is natural gas. This one had a good last couple of weeks and starting to see an uptrend there. Let's see what else. What else? Let's look at the S&P. Right, we're having an update today. Nice little positive week last week, off of major support, 200-day moving average. This kind of breakout area on the S&P, 382. Touched that slightly, and you wouldn't say it touched it, but it got pretty close to it. Now, could we see a retest of that level? I think that's certainly possible over the next couple of weeks. But for right now, you have to be kind of neutral to positive on risk assets as long as that dollar stays relatively relatively weak. And the NYSE, another resurgence today, another about an up week yesterday. And so you're seeing small caps, which had been relatively weak, having a nice up day today. It was pretty weak on Monday. So this is holding that major support and obviously helping commodity or equity prices more broadly. Let's take a look at the junk bond market. You had a relatively weak week last week overall, and you're getting a pause today. So this isn't breaking up or down, but this rollover is something to be watching. And do you get a major breakdown, or is this kind of a pause in a broader uptrend? We're still not, until we break these levels, I think you're still in a relatively uptrend in the credit markets, and that should hold equity prices together. The pullback in equity prices has been pretty controlled. So this is a natural reset. Going back to the S&P, this is a natural reset. You're not seeing any major sell-offs on high volume. You had one here breakdown, but you're not seeing a cluster of high volume where there's widespread moving out of equities. It's just kind of a refresh that I see happening in markets right now. Let's look at the KBE. This is the bank index. Obviously, you had the banking crisis in the spring, and you've had a lot of gyrations, but we haven't really gone anywhere. If you talk about end of March, we're pretty much flat. So even though the broad market is up, so you are seeing relative weakness in the banking sector, and I think there continues to be pressure there. So I don't love that sector overall. Let's see, what else do I want to get to? Industrials, they had been weak throughout the summer, but created a higher low. And this is a big reversal here last week, and you continue to see relative strength. So the industrial space, as long as this doesn't break down as well, I think is holding the economy together. And I think that's about it on this Monday. Oh, let's look at the move index as well as the VIX. So the move index, this continues to kind of consolidate, and this is what I'll be watching is are there more problems in the treasury market? We know if it gets above 150, that's an issue. There's dysfunction in the treasury market, and the Fed Treasury doesn't want that. This had been holding together well in the low 100s for pretty much all summer, and it was showing you that this pullback was nothing major. If this consolidation near term turns into another breakout in the move index, I will be worried about the treasury market and what the action of the Fed will be. They could go out there on the first, if that happens, and something. Sorry, getting a phone call from a colleague. Hold on one second. There we go. If that's something that breaks out the move index, then that would be a worry in how the Fed responds to that dysfunction, and they could come out with rhetoric in November that changes their tone to QT or raising rates, etc. And that'll be something to watch, and that would certainly weaken the dollar overall. Now the VIX, try to break out, try to get some movement to the upside. We barely broke into the 20s, so not a whole lot of freak out, but this is starting to calm down, and that is obviously good for risk assets as well. So overall, I would say I'm mildly bullish into year end. I don't think we'll see new highs, but could we close around the 4,500 level on the S&P? I think that's certainly possible as well. I will be on the lookout too with growth versus value to see if that continues. You had another attempt at a breakout last week, but a reversal on Friday and a bit of a follow through on this Monday. So a lot to watch this week as we enter a more difficult geopolitical time. So I want to thank you all for tuning in. Appreciate you all liking and subscribing. And a reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation of buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.